So after a spectacular year, spectacular is an understatement by the way, Tencent shareholder have something to look forward to. So it was announced just 3 weeks ago that Tencent will distribute most of its stake in JD.com, amounting to a little bit more than $15 billion as a special dividend to shareholders. So this would also mean that Tencent will no longer be JD's largest shareholder, and their stake will drop from 17% all the way to 2.9%. On top of that, Tencent has also recently announced that they'll be reducing their stake in Sea Limited from 21% to 18.7% by selling it to the market and the conversion of the share class. So I will talk about the implication of their investment portfolio as a whole later part of this video. So on the same day of the JD announcement, I ran a quick poll on my YouTube community tab to get some ground sensing on what you guys thought about this entire development thus far. So I thank all of you 1,600 people who participated in the poll. So according to the central limit theorem, where my n is larger than 30, the distribution of the sample is approximately normally distributed, and the community has came to a verdict. So it might be biased or it might not be, but this is just what the viewers of this current channel thought of about this entire Tencent divesting in JD. So we have an overwhelming number, around 45%, who feels like this divestment is forced by the CCP, while the other 31% thought that it was good for Alibaba. So I have to be the first to admit, since I was the one that created the poll, the options provided in the community tab might be phrased with an inherent biasness. Even though it might not look like a bell curve, just some editing magic, it's a bell curve now. And since this is my channel, I get to choose more than one option. Yes, I'm unreasonable. Just work with it. Anyway, I think this special dividend has more dimensions to it, rather than just a simple one-line reasoning. And if you want to hear my opinion, do stay till the end. So we will talk about the specifics of these arrangements first. You know what else needs to be arranged? You smashing the like button, of course. So what are you waiting for? Please help me turn it blue and help boost my ego. Now, in the official declaration document from Tencent, for every 21 shares of Tencent, the investors will be entitled to one Class A ordinary share of JD.com. So for those of you who are interested in the specific mechanisms behind the issuance and have questions such as, oh, what happens if it's an odd lot, and what if I don't receive the minimum number of shares to sell, etc. I will leave a link to the official documents down below in the description for your own reference and for you to read up on some of the specific criteria. So I think the main thing I would like to discuss in this video is the basis and the motivation behind this special dividend that was issued to shareholders. So let's first look at the official reasoning given by the Tencent's board of directors. So they say that this issuance is in the interest of both the company and the shareholders because their investment objective was to support and share in the investees' growth and where appropriate to exit the investments as the investees become consistently capable of self-financing their future initiatives. I know it's a very long chunk, but if you were to look at JD's business objectively, especially when it is the leading competitor to Alibaba today, I think we can safely make the case both for and against whether JD is ready for self-sufficiency. And I would like to emphasize both cases, for and against. So like I alluded previously, I think JD was definitely punching above its weight given the crackdown environment and the slowdown in China over the past few quarters. And I believe for those of you who are extremely concerned investors of Alibaba know of this entire development surrounding JD's prowess in the e-commerce industry. So this might also signal to the rest that JD's model has developed a certain level of resilience over the years. So there will never be an appropriate time to sell or divest. You can make for a case either way, and whatever Tencent's management team do, there will always be naysayers and people unhappy about the decisions that they make, and you cannot ever please everyone. I must however praise Tencent's management decision to unlock shareholders' value though. It was definitely an extremely bold move that raised many people's eyebrow, and people were taken aback by this entire announcement. So let's look deeper into the decision on why they decided to make this particular one. So the first and of course most obvious reason is to unlock shareholders' value. So this is coherent with the explanation provided by the board of directors. So the interesting thing about this course of action was really how Tencent played with this set of cards they were dealt with. In order to unlock shareholders' value, they could very well just unloaded JD's share in the market and convert it into cash and retain it on their balance sheet, but they did not do so. Instead, they are providing the flexibility to the various Tencent shareholders to determine the level of their own participation in the JD's business at their own discretion. So upon the special dividend announcement, JD.com shares actually plunged 11.2% in Hong Kong, while Tencent rose by 5.7%. So these are essentially people trying to do arbitrage, and Tencent shareholders essentially trying to realize their dividends beforehand. So this move that came from Tencent was actually very smart, in my own humble opinion, of course, especially with the environment the Chinese equities are currently operating in today. So I would venture a guess that, hey, if they decided to sell their JD position in the open market at their own discretion and retain the cash on their own balance sheet, it might actually cause a reverse impact, because not only will the media go on to say that they were forced by the CCP to divest their JD shares, they will even go above and beyond and argue that the proceeds from JD will essentially be donated to the government in the upcoming quarters. You know what I mean? People's imaginations will definitely run wild, and it might even cause Tencent's share price to fall even further. That's the sentiments today. What a time to be alive. Not only that, I would also hazard a guess upon this announcement, JD shares will take a nosedive if they decided to sell them to the open market. Fortunately, the discussion online surrounding Tencent just stays in the domain of, oh, it's just regulatory crackdown and anti-competition. So the general consensus still revolves around increasing competition amongst the different tech giants by weakening partnerships, exclusivity, and other arrangement which weakens competitive pressures. So this then breached very nicely to the second most picked option, where Alibaba will be benefiting from this divestment. So although Tencent did say that, hey, they will continue to have an extremely good business relationship, including an ongoing strategic partnership agreement. Basic Psychology 101 tells all of us as investors that even though they will remain strategic until they won't, especially when you no longer have a skin in the game. Furthermore, let's also not forget that they also have a relatively huge stake in Pinduoduo, which is also in the same e-commerce industry. A 17% stake compared to a 2% one will result in a vastly different decision when conflicting situations actually arise, especially when it concerns JD versus Pinduoduo, if something were to really come in between the two. And for people who are in this for quite some time now, it was quite obvious that Tencent was running a proxy war with Alibaba by funding all of its competitors. So this divestment probably signals the start of a new equilibrium. I must also admit that during the year-long crackdown, Alibaba was clearly affected by some anti-competitive behaviors they were engaging in prior to this crackdown. But let's not forget that it's not a firm-specific attack, but rather to make a much more fairer playing field for all the different companies in the industry. So on that same note though, whatever walled garden that they have previously is also slowly showing cracks as the pressure from the top intensifies, which also means that you win some, you lose some, depending on how you see this entire evolution of the crackdown in China thus far. Lastly, how can we not talk a little bit about the prediction for Tencent's investment portfolio moving forward? To just outline my own personal prediction for Tencent, hashtag not financial advice of course, China probably have no problem with Tencent investing huge amounts of money to help encourage innovation and to get the entire flywheel turning. They are probably just extremely uncomfortable with Tencent's role in trying to tip the scale and benefit the different companies that Tencent has a stake in. So with this line of logic, I'm quite sure Tencent's portfolio of Tesla, Sea Limited, Spotify will remain largely and strongly intact, unless they deem those companies to be underperforming and wishes to reduce their own exposure, or if they identified other opportunities for the said cash flow and wish to start divesting. So China probably couldn't care less about the overseas companies, big unless here by the way, if they have a disproportionate impact in China. I also highly doubt that international companies will have a huge impact in China because most of them get banned anyways. Furthermore, these international investments can also be seen as a store of quote-unquote soft power for the Chinese government as they attempt to maybe negotiate and to talk to other countries' counterparts. So you can look at Tencent as a solid rendition of Temasek Holdings. Who knows? So the recent disposal of Sea Limited from Tencent's portfolio was only trimming 10% of its stake, and the conversion of share class would probably have no material impact to either company. Tencent still has loads of skin in the game, so I do stand by my opinion that hey, overseas investments will probably be largely insulated from any developments inland in mainland China. On the flip side though, if you were to look at mainland investments, such as more locally specific, I understand some might be worried about their exposure in companies like Pinduoduo, Meituan, Huya, etc. So I believe as long as they do not hold a monopoly over that particular industry, it should generally be fine. That said though, the next compelling industry for Tencent to start role-playing Santa Claus again and start giving out Christmas presents would probably be the streaming industry by giving out Huya or even Douyu shares. Just my speculation of course. Moving forward, I believe Tencent will still be very active in sourcing out for both local and international investment opportunities to essentially try to harness their tech prowess and exposure. But I would also believe that there are many more things up for consideration, more so when attempting to try to dominate a particular industry. So the emphasis might also start shifting overseas instead. Do share in the comment section what you think, and I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!